What is the stock market? The stock market is a place where horses trade ownership pieces of companies, just like horses trading hay bales at the stable market. Rich Horse wants to understand how companies work and make money. Let's see how this stable market functions. When a company needs more hay to grow its business, it can sell small pieces of itself, called stocks or shares. Think of it like this. Imagine Rich Horse owns a big carrot farm but needs money to buy more land. Instead of borrowing money from the bank, Rich Horse decides to sell 100 small pieces of his farm to other horses. Each piece gives the owner a tiny part of the farm and a right to some profits. How stock trading works. When horses want to buy or sell these company pieces, they go to the stock market. It's like a huge stable where thousands of horses gather every day to trade. Horses shout prices. I'll buy Apple shares for 150 horseshoes. Or I'm selling Tesla for 200 horseshoes. But nowadays, most of this happens through computers, not actual shouting horses. The price of each stock goes up and down based on how many horses want to buy versus how many want to sell. If many horses think a company will make lots of carrots in the future, they want to buy its stock and the price goes up. If horses think the company will lose money, they sell and the price falls. It's like a continuous auction that never stops. Why horses invest in stocks? Horses buy stocks for two main reasons: dividends and capital gains. Dividends are like getting free hay every few months because you own a piece of the company. If the company makes good profits, it shares some money with all the horses who own its stocks. Capital gains happen when you sell your stock for more horseshoes than you paid. Buy low, sell high. That's the stable motto. But here's the important part. Stock prices can also go down. Rich Horse might buy a stock for 100 horseshoes today, and tomorrow it could be worth only 80 horseshoes. This is called risk, and every horse investor must understand it. Sometimes horses lose money, sometimes they make money. The market goes up and down like a wild bronco. Stock market dangers. Many horses think the stock market is easy money, but that's a dangerous myth. Some horses try day trading, buying and selling stocks every day hoping to make quick profits. But most day trader horses end up losing their hay because they're gambling, not investing. The market is unpredictable in the short term, like trying to predict which way a spooked horse will run. Other horses fall for stock tips from social media influencers. These influencer horses often get paid to promote certain stocks, just like promoting gambling games. They show their fancy stables and expensive carriages, claiming they made it all from stock tips. But they're usually lying or have special deals that regular horses don't get. Smart investment strategy. Smart horses don't try to time the market or find quick riches. Instead, they buy pieces of good companies and hold them for many years. This is called long-term investing. They buy a little bit every month, regardless of whether prices are high or low. This strategy is called dollar-cost averaging. The wisest horses also diversify their investments. Instead of putting all their hay in one company, they buy stocks from many different companies in different industries. Some might buy technology companies, others buy food companies, banks, or healthcare companies. This way, if one company fails, they don't lose everything. Market indices and mutual funds. Most horses don't pick individual stocks because it requires too much research and knowledge. Instead, they buy index funds or mutual funds. These are like buying a basket that contains pieces of hundreds of different companies. When you buy one share of an index fund, you automatically own tiny pieces of 500 different companies. It's like buying a pre-made hay mixture instead of selecting each type of grass individually. The most popular indices are the S&P 500, which includes the 500 biggest American companies, and the Dow Jones, which includes 30 major companies. These indices show how the overall market is performing. When horses say the market went up today, they usually mean these indices increased in value. Economic factors affecting stocks. Many factors influence stock prices beyond individual company performance. Interest rates set by central banks are crucial. When interest rates are low, horses prefer to put money in stocks instead of savings accounts. When rates are high, safer investments like bonds become more attractive. Inflation also affects stocks differently. Some companies can easily raise prices when inflation rises, protecting their profits. Others struggle when their costs increase faster than their revenues. Political events, wars, natural disasters, and economic reports can all cause stock prices to jump around like nervous horses. Getting started safely. Horses who want to start investing should first build an emergency fund with 3 to 6 months of expenses. Never invest money you might need soon. Start small and learn as you go. Open an account with a reputable broker that charges low fees. Begin with broad market index funds rather than individual stocks. Most importantly, educate yourself continuously. Read books about investing, understand basic financial statements, and learn about different types of investments. The stock market rewards patient, informed horses and punishes those who act on emotions or chase quick profits. Remember, investing in the stock market is not gambling when done correctly. It's about owning pieces of productive businesses that create value over time. The key is thinking like a stable owner, not a racetrack gambler. Smart horses build wealth slowly and steadily, one stock at a time.